All right, let's jump right into this explainer because today we're going to solve a massive financial mystery. We are going to look at why, arguably, the most boring asset on planet Earth is secretly dictating your financial life. When we think about the global economy, it's so easy to just get caught up in the loud, flashy headlines, right? But the reality is, the actual foundation of global liquidity has been quietly shifting right beneath our feet. So we're going to break down exactly why the yen carry trade broke. It's this massive, basically invisible engine of the global markets, and its recent unwinding is a huge deal. More importantly, we're going to talk about exactly what this complex situation means for your wallet. So to really unravel this whole thing, let's start with a question that honestly hits incredibly close to home for pretty much anyone trying to buy a house or invest right now. Why won't mortgage rates fall even when the Federal Reserve talks about cutting rates? I mean, it is incredibly frustrating. You constantly hear the Fed is going to ease up, they're going to cut, but financial conditions on the ground still feel painfully tight. Home affordability stays strained. Well, to understand why your local housing market is acting this way, the answer actually doesn't start in Washington, D.C. It starts all the way over in Tokyo. Now, traditional financial media, they're always telling you to worry about, AI bubbles or political feeder or trade tensions with China. But the real threat, the actual systemic risk, it's been hiding in plain sight this whole time. Japanese government bonds. Seriously, for the last 30 years, this incredibly boring, sleepy asset has effectively been the financial duct tape, quietly holding the entire global financial system together. And right now, that duct tape is starting to peel off. To really understand this duct tape, we actually have to rewind the clock back to 1992. That's when Japan's massive real estate and equities bubble spectacularly burst, sending them into what economists call the lost decades. Basically, for 30 years, the Japanese economy just hit pause. There was virtually zero real growth, no inflation, no wage expansion, just an incredibly long, agonizing period of economic stagnation. Fast forward to 2024, and the Bank of Japan finally ends this multi-decade pause. But it really begs the question, what exactly were they doing during all those lost years? Well, to fight off all that deflation, the Bank of Japan did something pretty extreme. It's called yield curve control. They cut interest rates to zero, then they literally pushed them below zero, and then they introduced this policy to actively cap long-term bond yields at a very specific target, completely regardless of what the open market actually wanted. Basically, the Japanese government took super glue and glued interest rates to the floor. Now put yourself in the shoes of a Japanese pension fund or a bank for a second. Your domestic government bonds are paying you literally 0%. You cannot make any money at home, so what do? You are essentially forced to go shopping overseas to find any kind of return. And this right here is exactly how this dynamic generated what felt like completely free money. Imagine an investor, let's just call him Bob. Step 1, Bob borrows money in Japanese yen at near zero interest rates. Step 2, he converts that yen into US dollars. Step 3, he takes those dollars and buys US treasuries that are yielding, say, 4%. After covering some basic hedging costs and a few fees, Bob literally just pockets that spread. This simple three-step process is the famous yen carry trade. And look, as long as Japanese rates stayed glued to zero, doing this was an absolute no-brainer. Because it was such a massive no-brainer, this trade just exploded in size. This incredibly cheap Japanese liquidity essentially became the world's global Wi-Fi. At its absolute peak, experts estimated this trade was in the trillions of dollars, trillions with a T. It became the invisible engine that global markets ran on. Investors weren't just stopping at US treasuries anymore. They were taking this hyper-cheap yen and pouring it into tech stocks, real estate, emerging markets. Basically, if an asset had a pulse and yielded anything above 0%, this massive flood of Japanese capital was there to buy it up and inflate its value. But here is the catch. The entire yen carry trade relied on one massive, incredibly fragile assumption. The Japanese yields would stay near zero forever. 17 years. That is how long it had been since Japan raised interest rates. Think about that. But in 2024, the foundational assumption of this massive global trade just absolutely shattered. The Bank of Japan officially ended its yield curve control policy, and they raised interest rates for the first time in 17 years. And then, shortly after that, they raised them again. The duct tape we talked about earlier officially peeled off. So before 2024, you had this environment of ultra-cheap borrowing. It was literally a river of free money flowing out of Japan and providing liquidity to the rest of the world. But the exact moment those Japanese yields began to rise, the math immediately flipped. Suddenly, borrowing in yen became expensive. Hedging your currency risk, that became an expensive liability. The free money trade simply wasn't free anymore. And you know what happens when the math flips? The capital flows flip right along with it. That massive river of money suddenly started rushing back home to Tokyo, which is an event known in finance as repatriation. And let me tell you, the sheer terror of this unwind was palpable almost instantly. I mean, we saw a shockwave violently ripple across global markets. The S&P 500 dropped a quick 6% shortly after the rate hike decision. But even more dramatically, Japan's own index, the Nikkei 225, absolutely plummeted over 12% in a single day. To put that into perspective, that was its absolute worst drop since 1987. It was just a crystal clear signal that global markets were officially spooked by the prospect of this cheap, easy liquidity disappearing. To really grasp why this is so much bigger than just a couple of bad days in the stock market, legendary investor Ray Dalio actually hit the nail on the head. He said, "The bond market is the basis, the backbone of all markets. It determines what all asset returns are going to be." The absolutely crucial point here is that for decades, Japan hasn't just been some random casual investor. They have been one of the most consistent, price-insensitive buyers of long-term U.S. debt in the world. When their massive demand for that debt falters, it literally shakes the very foundation of how every single other asset on Earth is priced. And that brings us directly to a massive, glaring vulnerability for the United States. We are currently running trillion-dollar deficits annually. The U.S. Treasury has to issue staggering amounts of new debt every single year, literally just to keep the lights on. And we desperately need price-insensitive buyers to absorb this constantly growing pile. So if Japan, historically one of our absolute biggest buyers, steps back because they're busy repatriating their funds, basic supply and demand takes over. To attract new buyers for all this debt, long-term yields simply have no choice but to rise. This whole situation builds into what we can really call an everything story. And this is exactly how the unwinding of the yen carry trade reaches directly into your wallet. First off, stock valuations compress. When analysts figure out what stocks are worth, they use long-term yields as a baseline. So higher yields mean those future cash flows are suddenly worth less today. Second, just like we asked at the very beginning, mortgage rates stay pinned. Even if the Fed cuts short-term rates, your 30-year mortgage is tied to the 10-year yield. If global demand for our debt drops, long-term yields stay high, and unfortunately, so does your mortgage. Finally, corporate credit tightens. Elevated borrowing costs slow down business growth, they slow down hiring, and they stall deal flow. It affects the whole shebang. Now, mainstream media largely ignores this complex unwinding because, frankly, it requires patience and nuance to understand. It's not a flashy, clickable headline. It is definitely not going to trend on social media. But the absolute reality is this: liquidity is the oxygen of the markets. When global liquidity contracts because the yen carry trade is breaking down, the air in the room gets very thin very quickly. The popular narrative that one simple rate cut by the Federal Reserve will just magically fix everything is a massive oversimplification. The real threats to your portfolio and to your purchasing power are almost always the ones hiding right there in plain sight. So, let's bring this all together. The U.S. benefited for 30 straight years from being on the receiving end of the world's largest carry trade. Now, that massive trade is unwinding. So, as we watch these trillion-dollar deficits continue to pile up, we are absolutely forced to ask ourselves a pretty terrifying question. If the world's biggest, most reliable buyer of our debt suddenly stops buying, who will?
Thanks so much for watching. If you found this useful, smash that subscribe button and hit the bell. It really helps this channel grow. Catch you in the next one.